Happy Thursday, y'all. Let's go. Interest rates had a slight dip to get back to the lowest rates that we've seen in 3 years. We even had a one day with a 5.99% average. Average top-end buyers in right now at 6%. We don't expect to see major improvements from here soon. Almost all the major forecasts are at 6% or above, with Morgan Stanley as the lone wolf forecasting as low as 5.5% in the middle of the year. Looking at PCE inflation, the Fed favorite, core PCE inflation increased to 3% year over year. That's the worst since April 2024, and it's heading the wrong way. This is directly contradicting the CPI inflation reporting. PCE is also usually lower than CPI, and this divergence is strange. The biggest factor is how the models handle this doctored housing inflation data. Also, something to note is the Fed had a very slight mention of chances of increasing target rates in the near future. However, the market is betting 0% chance on that and is actually still betting on rate cuts this year. Looking at consumer credit, foreclosures are increasing but still very low. Still something to watch, as some houses bought in the last few years are underwater on their mortgage, making a quick exit difficult. Delinquency on subprime auto loans continue to climb, while the prime loans are still staying steadily low. Credit card delinquencies continue to trend downward, and percentage of consumers with third-party collections continues to be very low. What does this mean for you? I wouldn't be waiting for rates to drop in order to make a real estate decision. Also, consumers are still paying their bills. And if you have questions about this data or buying a house, let me know.